So, if you're a business owner with an industrial property, there's a specific tax rule you absolutely have to know about. It's called Section 540D. And trust me, it can be a total game changer, especially if the government ever comes knocking at your door. Let's just paint a picture for a second. You get an official notice in the mail. The government needs your factory, your land, for some new highway or public project. And it's not a negotiation, it's a compulsory acquisition. Now, that's obviously a huge shakeup for your business, but it also kicks off a major financial event. And yeah, you heard that right. When your property is acquired, the compensation you get, well, it's probably going to trigger a pretty significant capital gain. And if you don't have a plan, a huge chunk of that money you desperately need to relocate and rebuild, could go straight to the tax man. But there is a powerful tool designed for this exact situation. So let's stop thinking of Section 54D as some complicated tax jargon. Instead, think of it as your financial shield, built specifically to protect your capital and help your business land on its feet. So what is this thing really? Well, at its core, Section 54D is a pretty straightforward deal from the government. It says, hey, if we have to compulsorily take your industrial property, the profit you make, that capital gain, can be completely tax-free. But there's a catch. You have to reinvest that money back into new industrial assets. It's basically a lifeline to help you keep your business running. Okay, so this sounds amazing, right? But hold on, it's not a free-for-all. You can't just claim it. There are some very specific boxes you have to tick to qualify for this tax relief. Let's run through the checklist. There are 3 main hurdles to clear. First, the property, your land, your building. It has to be part of an actual industrial business. Second, this can't be you just deciding to sell. It has to be a compulsory acquisition, required by law. And third, you can't have just bought the place yesterday. You must have been actively using it for your business for at least 2 years right before the acquisition. But honestly, the most critical element here, the one thing you absolutely cannot forget, is the timeline. The second your property is officially transferred, a 3-year clock starts ticking. You have exactly 3 years from that date to buy or build a new industrial asset. This is a hard deadline and there are no extensions. Now, what you reinvest in obviously matters. It has to be another industrial asset. But what if you get the compensation money, but you haven't found the perfect new spot before your tax return is due? Are you just out of luck? No. That's where something called the Capital Gains Account Scheme, or CGAS, becomes your best friend. It's basically a government-approved parking spot for your money. You deposit the funds there, which signals your intent to reinvest, and it keeps your tax exemption safe. All right, enough with the theory. Let's get to the good part, the money. Seeing how the math actually works is what really shows you the power of Section 54D. It really boils down to 2 simple scenarios. First, if your capital gain is bigger than what you spend on the new asset, then your tax exemption is capped at the cost of that new asset. Simple enough. But in the best case scenario, if what you spend on the new place is equal to or even more than your capital gain, then your entire capital gain is wiped out. It's tax-free. That's the goal, right? To make that tax bill disappear entirely. To make this crystal clear, let's put some real numbers on it. We're going to follow the story of Mr. Anban, an industrialist who went through this exact process. So, boom, after the government acquired his property, Mr. Anban's capital gain was calculated to be 75 lakh rupees. Without Section 54D, that is a massive number that he'd be paying tax on. Now, he's smart. He knows about that 3-year clock, so he acts fast, finds a new industrial plot, and reinvests 50 lakh rupees into it. So how does the math shake out for him? Well, since his reinvestment of 50 lakhs is less than his total gain of 75 lakhs, his tax exemption is equal to the amount he put in, that full 50 lakh rupees. And here's the final result. His taxable gain plummets from 75 lakhs all the way down to just 25 lakhs. That's a huge, huge win. Of course, if he had managed to invest 75 lakhs or more into a new asset, that taxable gain would have dropped all the way to 0. Now, getting that exemption is fantastic, but, and this is a really big but, you also have to make sure you keep it. There are some critical rules and potential traps you absolutely have to know about. So let's imagine you did everything right. You reinvested, you claim the exemption, your new factory is up and running, but then just a year later, someone comes along and makes you an incredible offer for your new property. What happens if you sell it within those first 3 years? Well, the answer is pretty harsh. The tax exemption you got is completely revoked. It's clawed back. That original capital gain that was shielded in Mr. Anban's case, that 50 lakh rupees, it snaps right back and becomes taxable in the year you sell the new asset. The government basically sees it as you not holding up your end of the reinvestment bargain. Okay, let's boil this all down to the absolute essentials you need to remember. Number 1, that 3-year clock is everything. Don't miss it. Number 2, reinvest only in qualifying industrial assets. Number 3, do not sell that new asset for at least 3 years, or you'll face some serious consequences. And finally, number 4, remember that the capital gains account scheme is your safety net if you need more time to find the right property. And that brings us to the final question. Look, having your property compulsorily acquired can feel like a major setback, but with the right knowledge, it doesn't have to be a financial disaster. Section 54D is literally a roadmap to turn a tough situation into a strategic reinvestment. The real question is, are you prepared to use it?